Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to the three topics that we normally talk about: wealth building, financial topics, and or commodities. That's where the value is. Let's take a look and see what's going on today. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com. I dive into all this stuff looking for potential investment opportunities. I share my thoughts very freely about the companies that I am looking at. We're going to go over some more presentations so you guys can get more familiar with the companies that I really like. The big cash cows, buying back shares, paying dividends. And I'm here to educate everyone on the companies that you own, why you own them, what the setups look like, and then you can see the correlations between all of that. So if you're interested in signing up, go ahead and sign up. Use discount as the coupon code. So Dr. Jim Willie, he says, the silver tsunami is here. The global elites have been suppressing silver prices for decades, but their grip is slipping fast. In 2024, silver will smash through $50, and in the coming years, it could soar to $300 plus levels. And I think he means 2025. Take heed. Without securing your silver supply now, your EVs, solar panels, and space projects could face an existential crisis. The clock is ticking. With dwindling supply, surging demand, depleted inventories, and a mining revolution underway, silver is set to explode. As the system collapses, silver will rise. Protect yourself. Buy physical silver now, in his opinion. This isn't just an investment, it's your financial lifeline. And I agree. I do think that you should have some allocation to physical metals in a portfolio. I do. Now, some people ask, well, how big of an allocation should you have? I don't know what anyone should have. I have my own thoughts and reasons behind allocating to physical metals. They may be very different than everyone else's. Some people find physical to be annoying. They have to store it, and it may cost for them to store it. Others look at it like it's the best thing that you can buy because you are diversifying out of the financial system. So that's kind of what you have to balance when you're going into the physical metals on the reasoning. So here's XOP ETF versus oil, the physical commodity. So this is a lot of the stuff that I look at, the ratios. I was just looking at XOP versus crude oil. We've got a big long-term downtrend line break. What that means is that we were going from a high, a outperformance area to an underperformance area between 2015 and we broke out in 2021. So XOP was underperforming crude oil. Now in 2021 onward, we've broken out against crude oil. We consolidated here. And then if you zoom in on the right-hand side, this is with the right-hand side, we've broken out, and then out of nowhere, we had this big 1, 2, 3, big selling pressure move back that has happened recently. It's as if people don't want you to buy XOP, which is weird. I also see this a lot where the big boys haven't gotten enough of their shares and they try to scare people out and then they flip it. So they try to gap it down in the morning and then buy shares throughout the day. If you see that, that's probably what they're doing. They're trying to get a position before the move. Here's some more other oil ratios. This is gold to oil ratio. I am still in the camp. And I'm not saying that it can't do a little wick. It could, but it's looking less likely that it's going to do that wick. So what I see is I see in the 90s and all the way up, I see this big move higher, shoulder, head, shoulder. And we could be scribing out a right-hand shoulder. And it doesn't have to be in the location it's in. It could go up a little bit, but it's looking less likely like that. And the reason it's looking less likely, because if we zoom in on the right-hand side of this ratio, which is at an incredibly low ratio. It's what this means is that gold has moved on up. Crude oil has moved sideways to lower. It's consolidating while gold is running. And it's created a ratio of around 38 to 39, which is incredibly cheap for oil. And if we look, we can see that we're starting to break just this short-term trend line to the downside. Now, is this a new beginning trend where we can start to go lower? Maybe. I'm not banking on it for a short-term trade. I'm watching it to see if it goes lower. Now, we're at 38.1 when I ran this chart. 38.1 is incredibly cheap for crude oil. And what's difficult for most people is that when we buy crude oil up here, everyone's going to be bearish on crude oil. That's how we got to the ratio in the first place up here. So all these people who are bearish, they're telling you crude oil is not going to go anywhere. It's going to go down. They're going to start writing articles about oil gluts and all this other crap. And that's what you have to buy against. You have to be separate from the herd. Now, if I buy at 38.1 and let's say it goes upward and it gets cheaper, people are going to tell me, well, you're wrong. Well, not really. I mean, that's like buying a brand new car at a 50% discount here. I just missed the 60 or 70% discount when it went up a little bit more. And there's no saying that I can't buy multiple cars too, so to speak, using the analogy. I can buy one at a 50% discount and I can buy the others maybe at 75% discount. And if it goes back into another market condition where we go into a more expensive market condition like down here, I win on all of it and I win big. So what is the difference between me and everyone else? I adopt a longer time frame, period. I know what the oil markets look like in terms of a lot of these forecasts and estimates. I know where inventory levels are at. I know where the spare capacity is and how much that spare capacity is. I know where the cost curves are at for the majority of these oil companies. And I'm going to tell you this, we're at the cost curves right now. So if I can buy at the cost curve, I can buy when it's cheap against all of the other sectors. I've got a shoulder head shoulder pattern potentially here, and I can buy it at discounts. Why not? And when everybody is telling me that it sucks, that's the time I generally jump on it. Is when everybody tells me I'm dumb and oil's not going to go anywhere, and we're going to have 800 recessions. And if we get a recession and oil gets cheaper, that's my analogy to buying now at 50% off versus later at 75% off. And everybody thinks they can time this thing perfectly. I'm going to tell you this. These markets look pretty difficult to time here in terms of the recession that people are calling for. People point to certain things. Certain data does look pretty bad. And I think that the recession is going to be very similar to 2000, 2001. I don't think we're going to go through a deleveraging crisis in residential real estate. I don't think we've got that many foreclosures. I don't think the loans are near anything near the 1920s or the mid 2000s. I just don't think they're like that. So I think that if we do get a slowdown, it'll probably be very similar to the 2000, 2001 slowdown. And here's some more long-term charts on oil. And whenever I'm talking about a certain topic or sector, that's generally what I'm bullish on. It's the things that are down. So this is crude oil divided by the S&P 500. And I flip these around. This is a double bottom. And it is starting to break. If you look and zoom in on this, it is starting to break in that corner there, which I didn't zoom in on that. But this was the last bull market from 1999 all the way up to 2008. There's your blow off top. And then we came back up in 2014 is when we came out of this. If you look at the charts, you can tell that it just blew out from shale. And then we reconsolidated down here in a double bottom. So this was the last bull market from 99 all the way to 2008, and 2014 is where it came off the rails here. Here is SPX divided by crude oil. So I flipped it around. And what I see here is kind of like a shoulder, a head, and then another shoulder maybe. And there's your neckline. And then we broke out and kind of went all the way down in 2008. Now, if you look at this, we flatlined in 2010, 2011. This is when money rotates. You want to go long in the S&P 500 here, and you want to get out of energy. And then you go into a big bull market in the S&P 500. And what we are putting here is a shoulder, head, shoulder topping pattern. We are putting in the right hand shoulder. And we've got a neckline roughly right where it is. It's the same pattern as this guy is over here for the most part. Very similar. We have a little mini kind of one here going on too. Now, if I can buy cheap stocks, and if this were to rotate back down, similar to what happened here after this, this is your 2002 and onward, I think something very similar is going to occur. And what happens here is, and this is exactly where I think we're in the 2000, 2001 era. 2000 was right in here. We had a move higher, and this is the move higher. And then we're going to get a rollover. The rollover is going to occur, in my estimate, in the dollar. And if the dollar rolls over, that's when emerging markets take off. And that's when crude oil and precious metals, all the stuff that's going to go. And what's going to cause the rollover in the dollar? The lowering of interest rates. And what are we doing with interest rates right now? We're lowering interest rates right now. That's the slowdown. So now we're going to look for the topping pattern in the S&P 500, a topping pattern in the NASDAQ. Now, it doesn't mean it will happen immediately. It's going to take some time. It could happen immediately. And then we're going to look for energy to outperform here at some point. That's what we're looking for. Here's crude oil versus Dow Jones Industrial Average. The last big bull market came to a falling wedge in the corner. It broke out in 99. We had a big pullback in that move there. And then we went all the way up. We have a 1, 2, 3 consolidation with a false breakdown in this falling wedge against the Dow Jones. Crude oil bottomed in 2020, shot higher out of the falling wedge, and we are creating another falling wedge pattern, which is this pattern here. And that is why I think that we are in the 2000, 2001 era. It's this exact region. It's the same type of pattern if I were to throw a falling wedge on this. It's the same thing. I think that we're going to see crude oil outperform the Dow Jones at some point here in the future. In crude oil versus Dow Jones, there it is, doing a little false breakdown perhaps. And then maybe we can get some move higher here very soon. And this is more information about the S&P 500 and why I think this is going to occur. The S&P 500 price to book ratio has now surpassed its March 2000 peak. This is where I think we're located. We've got the same fractals as last time. It's all interconnected, guys. So it says has now surpassed its March 2000 peak, signaling valuations at levels not seen since the dot-com bubble, meaning investors are paying more for stocks relative to the underlying value of companies' assets than they were during the tech bubble. And we are very similar here. So could it go a little bit higher? Yes, it could. Am I going to nail the exact peak? Probably not. But are we close enough where I'm going to start buying the undervalued asset? Yes. I already bought the undervalued asset. I bought it in 2020 at the peak here. And I swapped my, I owned a lot of technology stocks back then. I sold them in 2019. I didn't completely time it perfectly. I missed the big move, downward move in 2020, and I bought a lot of gold mining companies at the bottom of 2020, April in particular. And then I sold out of those and bought a bunch of oil and gas in September, October of 2020. And I've purchased a whole bunch from there on as well. The dude, remember, they don't want you to own gold and silver. They want you chasing crypto before the reset. You are living through the crypto psyop, and that is completely true, and I believe that to be true. Now, is it really the truth? I don't know, guys, but I can tell you this. I can see them pushing crypto. Trump, the crypto capital of the world, and people on Twitter here are talking about crypto nonstop. I don't want to be there. If everyone's there, if the herd is there, I'm out. I don't want anything to do with it. Now, nobody is telling you to go buy gold and silver. That's where I'm going. I'm running as fast as I can to those physical metals to get my money out of the system. They're trying to suck you into the system. Go buy crypto. And then what they're going to do, the herd just chases price. That's all they do. They FOMO, fear of missing out, and they FOMO into things. That is how they are controlling the herd. I'm not a part of the herd. I never was part of it. So I'm going to go where they don't want me to go. Get me out of the system. So here's Jacob King and more information. Business model is a giant scam and relies on reflexive loop. It issues debt or equity to buy BTC, which drives BTC prices higher. STR's market cap boosts its index weight and attracts more sheep investors. With a higher valuation, it issues more equity to buy even more BTC. The cycle only works if BTC keeps rising. If BTC stalls or crashes, which it will at some point, the loop collapses. This is unsustainable and is a giant Ponzi in his opinion. This scheme is even bigger than FTX, Bernie Madoff, and Enron. When it collapses, it will make history. Now, is that true? I don't know, guys. All I know is that when things are overvalued and the herd is buying this stuff, I'm running away. I don't want anything to do with it. Nothing to do with it. So here's Josh Young. Odd. It's almost like it was an election year. So this is what's going on here. And this is why it's really difficult to know exactly where we're at in the cycle. So Lynn Alden writes, this is the first time in history of the data that over 40% of banks were tightening credit standards and then went back to not tightening without a recession having occurred. Question mark. Recession here, recession here, recession here, recession here, every single time. Now, here's the thing, guys. Maybe we already went through the recession, and what's coming next is going to be banks loosening credit. If that's where we're located, then maybe the slowdown is already behind us. Do you remember a few quarters that we had negative GDP, but they redefined what a recession is? They're in here playing with the numbers, redefining whatever the heck they want. I think we already went through the cycle. Perhaps, perhaps not. But it's a big question mark here, and I agree with it. Did we already go through it? Energy headline news. So global observable commercial onshore crude oil stocks drew 73 million barrels in the last 4 weeks, says Goldman Sachs. So we are drawing down inventory levels, and we're very low in inventory. But here's the weird thing. People are supposedly looking at spare capacity and saying, oh, it's okay. We have spare capacity in OPEC. In particular, Saudi Arabia. So here's my question back to everyone else. How much spare capacity is there? Do we really know what it is? Last bull market in the 2000s, when oil went from $10 a barrel to $150 a barrel, a 15x. Do you know how much spare capacity the world had? 2 million barrels of oil spare capacity. Our inventory levels were higher back then than today. We have less days of coverage today, and we don't know exactly just how much Saudi Arabia has for pumping capacity. I've read some things that states that they are having issues with their largest oil field, Ghawar, and that Ghawar is declining. If that is true, and I don't know if it is, but if it is, the spare capacity is way lower than what people think. And on top of it, we don't have a ton of inventory. We might be riding a lot thinner than what most people think in terms of our spare capacity. Now, do I know that for a fact? I do not. Does anyone know that for a fact? I don't think so, unless you're an insider in Saudi Arabia. And obviously, they're not going to come out and say anything. They don't want to spook the markets. They want oil to be trading probably around 90, 120, somewhere in that range, 90 something dollars, 100 something dollars a barrel. Coming on down, Patrick Karam says 50% drop in play if that rising support line fails. And this is NVIDIA jumping off of a very high cliff. Potential shoulder, head, shoulder with the neckline that's broken down, and we're at the long-term, the must-hold trend line. What we see in these markets is we see these roll over, aka the year 2000, 2001, very similar with tech rolling over. And then what we're going to see is energy and commodities and gold and silver bottom and go up, depending on what you're looking at. The bottom's already taken place, the ultimate bottom in 2020, but we're going to see a resumed move in oil, precious metals, while these guys roll over. Now, in the beginning of the rollover, depending on how this falls, it could impact everything. If it falls rapidly and you see margin calls, you could see selling of everything. If it goes slowly and there is not the big margin calls all at once, we could see precious metals and oil go up, even though this goes down. So we'll see what happens here. I don't know the price trajectory and how fast this will drop. Fartcoin market cap is now larger than silver's annual production. Gotta love Fartcoin. Ross Haber says, the big winners test your nerves before they reward you. Early on, I'd sell the first dip or shakeout. I learned the hard way that leaders pull back to shake weak hands. The question isn't if you can spot a leader, it's if you can sit through it. There's so much truth to that. And I am taking all of these guys' advice, not Ross, but just everything that I've been reading, I am taking it to heart. I am going to maximize my abilities to play this next commodities bull market. And I'm going to let everyone on the website know what I am doing to do that. If you need help, if you're getting shaken out of your positions, join our community. Get in there. We can help you. We're here to support everyone on that community. I'm here. I'm just I'll say I'm not necessarily the leader. I'm the facilitator of it all. I facilitate it. Samantha Leduc says value has been crushed. XLE, which is energy, XME, XLV, XLU, utilities, XLB, the home builders, while tech concentration risks continue higher. Says market is becoming more unstable, not less, with VXN and QQQ and VIX and all that stuff, which is true. Peterson says underweight U.S. techs, industrials, and discretionary add to energy and staples in their opinion. And I would agree with that. Energy is a big one here. I am going to make a buttload of money off of energy. And that's where I'm going to be. That's where I have I'll say, it's not just faith. It's the ability to look at energy and it just makes sense from a valuation standpoint and from a thesis standpoint, from AI coming, from increased electrical generation from natural gas, from oil and the the fundamentals of oil potentially in the future, shale potentially peaking. I mean, guys, it's almost like if you look at the fundamentals and the value and you tie it all together, it's like this could be a really big, it could start out as a base hit, but it could turn into a home run if the ball carries far enough. Nick Schmidt says, I used to believe every move in the market needed a reason, news, data, theories, something to explain it. But I learned price and volume tell you everything you need to know. The rest is noise. You use it to feel in control. Just trade what's in front of you. And Jesse Livermore says, it is not good to be too curious about all the reasons behind price movements. It's a waste of time to go find out. Just let it be, guys. Josh Young says, we think the EIA may be overestimating 2025 oil supplies from the US, Brazil, Canada, and Iran. If these come in below their expectations, watch out above. And the global oil market balance shows an upcoming call on OPEC per the EIA. And this is the gap, the call on OPEC of 0.26 or 260,000 barrels is probably what that is there. So we're going to be eating through whatever spare capacity we have starting next year. And this is where it's going to get interesting. If shale can't grow and demand continues to grow, what happens in 2026? We could eat through the entire spare capacity that the world has in 2026, depending on what that looks like. If shale doesn't grow and it actually goes down, and we have to eat through OPEC spare capacity, we could be at pumping capacity in no time. In 2026 even. That's next year. Who wants to tell them? So this is HFI's research, real-time U.S. production tracking. It's going down. This is a big uh-oh. Down at 13 point something million barrels. Could we get a move lower in shale U.S. oil production? And we eat through the spare capacity quicker than what everybody thinks? It very well is possible. We'll see what happens. Joseph Carlson says, reading about Tulip Mania is wild. It seems crazy that people were willing to pay tens of thousands of dollars for something that has no particular use or intrinsic value. Who would pay so much for something where the only bull case for it is trying to convince the next guy to pay even more? Anyway, history is crazy. Glad we have nothing like that going on anymore. And then guess what occurs here? John says, I know you're an old school mentality investor, and I love you for that, but this argument doesn't hold up against BTC simply because anyone, anywhere can grow and harvest more tulips. That is exactly why Bitcoin doesn't hold up any arguments of the past, because at the moment, and I state with humility, blah, 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 no one can create more BTC anywhere. The only current asset that has a fixed supply and global interest. And then what did he say? Clearly, I'm talking about Fartcoin, which is a 770 million market cap. He didn't say anything about Bitcoin here, guys. Nothing. And guess what the Bitcoin people come up with? Oh, that's not an argument against Bitcoin. They know it's freaking tulips. They know that, they know by reading this that they are correlating that with Bitcoin. Subconsciously, they are. I love it. I love it. That guy got him. Here's Matt Darren. He says, sorry, we got to go back here. Next one, Grady. It says, that looks like a clean breakout in the making for gold. And this is GDXJ versus GDX. Smaller companies are outperforming larger companies, which means that the sector is bullish. That's what you see when this starts to turn. You're bottoming. This is your whole bottoming pattern here. We're starting to break out of it. Here we go. Cash is trash. Fund manager. Cash allocations at record low. I'll bet, to be fair, bonds and commodities are cheap. So if not stocks, then those and not cash. So cash allocation fell to lowest on record. That's cash allocation. People are deploying it. Momentum structural analysis, which is Michael Oliver. He says people want to buy Fartcoin and Cumrocket and Hawkcoin and other stupid, useless garbage instead and gamble their money away. This is the bubble of all bubbles. Trump is our messiah, our savior. He's going to fix everything and we'll have a government like 1776 again. AI is definitely not just a flawed computer program subject to all of the biases of its programmers, and it's going to do everything for us so we can just spend our time betting on digital tokens. We'll never have to work again because we'll be so rich betting on Buttcoin 420. The utter insanity of this bubble is palpable. You can just feel the humanity has lost its collective mind. And that's where we're going to end it. So if you guys like the content, give me a thumb up, subscribe to the channel, subscribe to the website. The website does have its midweek update released. You can view that if you're part of the community. If you want to become a part of the community, go ahead and join. We do have a coupon code. Discount is the coupon code if you'd like to join and get a discount. And that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.